Remember the 2008 financial crisis? The collapse of Lehman Brothers, the housing market crash, the whole world hanging by a thread. It was terrifying. And it might just be the last real economic crisis we ever see. Now, before you call me crazy, hear me out. The old rules of economics, the ones we all learned in school or from the advice of our financial advisors, do not apply anymore. This has profound effects on the way we manage our savings, the way we invest, and the way society works in general. In this video, we're diving into the death of recessions. We'll look at how debt, stimulus, and money printing have turned the economy and investing upside down. We'll explore why cash is trash, bonds are jokes, and why everything you thought you knew about protecting your wealth might be wrong. Alright, let's rewind a bit and talk about the old rules of economics. You know, the ones our parents and grandparents lived by and which you still hear about in the traditional investing space. It used to be a pretty simple cycle. Economies would boom, then they'd bust. It was almost like clockwork. During the good times, businesses thrived, people spent money, and everyone felt pretty optimistic. But inevitably, things would get overheated. Companies would overproduce, people would take on too much debt, and asset prices would inflate into bubbles. Then, pop, the bubble would burst, the economy would contract, and we'd enter a recession or, in extreme cases, a depression. These downturns were painful, no doubt, but they were also seen as a necessary evil. They cleared out the excesses, allowed for a reset, and set the stage for the next period of growth. And here is the kicker. During these tough times, there were supposed to be safe havens. Cash was king, as they say. People would hoard it because it gave them options to buy cheap assets and avoid losing their value from the collapsing stock or real estate market. Bonds were another favorite, offering steady income when the other investments were tanking. These were the old rules of the game. But as we're about to see, those rules might be a relic of the past. The economic landscape has changed dramatically, and the old playbook might not work anymore. It all started in 2008, when the world financial system was on the brink of total wipeout. Too much debt and too much speculation on the part of Wall Street, to put it simply, caused one of the biggest challenges to the modern economy. Lehman Brothers, an investment bank that was 158 years old, collapsed with $613 billion in debt. This led to a contagion event where one by one the dominoes started falling. Long story short, in order to backstop the system, all the governments around the world turned to a novel method of dealing with such crises. It was called quantitative easing. This weird term basically means that the central bank creates money out of thin air in order to buy government bonds, mortgages, and even in some countries corporate debt and shares in order to save the system. This increases the amount of money and juices the wheels of the economy. It also increases the value of the collateral in the system so that it can be backstopped. Imagine it like this. You have a house that has 80% mortgage on it, and the bank doesn't want your debt to go above that number. So the house is 100K and your debt is 80K. That's all great until the value of your house drops to 60K. In that case, the bank will want you to put additional money in order to increase your collateral because you agreed it won't go above 80%. Now imagine you had a magic button which could now make the house go up to 110K despite the fact that it's less valuable and its real value should be 60K. Suddenly, because your debt is fixed at 80K and your house is worth 110, everything's sunshine and rainbows again. This is basically what the quantitative easing allows at scale. It increases the denominator of the assets that back the system and prevents everything from falling apart. If we check the amount of money pumped by central banks, which is seen in the increase in their balance sheet, you will understand visually what I'm talking about. Just a side note, when the central bank creates money, it buys something in the real world, which means that its balance sheet increases. This is why the increase in balance sheet is correlated to the money they create. As a response to the crisis in 2008, the Federal Reserve's balance sheet went from 900 billion to 2 trillion in a matter of months, which is more than 100% increase. In Europe, the central bank printed more than 1.5 trillion euros between 2008 and 2012 to backstop the system, also doubling the amount of money. The central banks were successful in saving the system. But something else happened. What happened was that this changed the rules of the game forever. It used to be that when depression hits, the people with cash and bonds suddenly had the advantage because they could buy assets at a great discount with their cash and had steady income from their bonds. This is no longer the case. the game changed forever. And if you don't believe me, the next crisis that hit proves it. And it dwarfed the 2008 one. The COVID-19 pandemic was like a giant economic experiment, unlike anything we'd ever witnessed. It was a real-life stress test for the global economy, and the results were both shocking and illuminating. Overnight, the world came to a screeching halt. Businesses shut their doors, global travel evaporated, and unemployment soared to levels not seen since the Great Depression. It was a deflationary shockwave, the kind that, according to traditional economic theory, should have triggered a massive collapse in asset prices. I mean, if you think about a deflationary event, I don't think we have ever had something close to that in our history. Perhaps only the Black Plague from the 14th century, but I guess there wasn't a lot of data gathered back then. Other than that, I can't think of an event that should have crushed the price of everything as much as the COVID shutdowns. We literally stopped the whole planet for over a year. A barrel of oil went down to negative prices because people literally did not even want to store it anymore. There was a picture I saw from an Indian town in which 40-year-old people were saying that for the first time they're able to see the Himalayan mountains in the distance, which are over 200 kilometers away. The reason was that there was such a lack of traffic, airplanes, and factories working that the air became the cleanest it had been their whole life. Literally, if there was an event that should have caused terrible deflation and asset price collapses created for a textbook, this would have been it. But then, something unexpected for the unprepared mind happened. Instead of crashing and burning, the markets went on an absolute tear. Stock markets rebounded with astonishing speed, real estate prices continued to climb, crypto, gold, everything reached an all-time high in 2020. And then, inflation got on a rampage, and the developed world saw the biggest inflationary shock and loss of purchasing power for decades. How could this be? The answer lies in the unprecedented response from governments and central banks around the world. They unleashed a tidal wave of stimulus, injecting trillions of dollars into the system to prop up businesses, support workers, and crucially, prevent a financial meltdown. If we go back to our charts, the Federal Reserve increased its balance sheet from 4 trillion to almost 9 trillion in the span of 2 years. And what is most important, during the months of March to June 2020, they increased it from 4 trillion to 7 trillion, the fastest increase ever. The picture looked the same in Europe. I want you to notice something. This is a chart of the S&P 500 between March and August 2020. Notice how it dropped sharply in March? This was supposed to be only the start. And in that time, the people with cash should have been able to capitalize and buy cheap S&P shares at a huge discount. However, that didn't last long. Only 4 months after that, not only had the S&P recovered, but it reached an all-time high. Isn't it weird that at the exact same time, the balance sheet, or the money printed in other words, of the Federal Reserve did this, the stock market went to an all-time high and did this. If that doesn't connect the dots for you, then I'm sorry, I'm powerless to help. This created a stark disconnect between the real economy, which was suffering immensely, and the financial markets, which were thriving. It was a surreal situation, like watching two completely different movies playing out on the same screen. The COVID-19 experiment revealed a fundamental truth. The old rules of investing, the ones that told us to keep a lot of cash and bonds in the case of recessions and depressions, do not apply anymore. Governments and central banks have shown they are willing to go to extraordinary lengths to prevent a collapse, even if it means distorting markets and creating potential long-term risks. The pandemic served as a wake-up call, a stark reminder that the economic landscape has shifted. It forced us to rethink the role of debt, the effectiveness of monetary policy, and the very nature of what constitutes a safe investment. Because if you think about it, a lot of people consider something like cash safe and something like stocks or Bitcoin risky. However, isn't it weird that in the biggest crisis of our times, the safe investment has lost over 40% of its value in the past 4 years, while the risky ones gained tens and even hundreds of percentages? I think by showing you this, we are now on the same page that the game has completely changed. So we've talked about how the old rules of economics might not hold true anymore and how the COVID-19 experiment threw a wrench into traditional thinking. But there is one more piece of the puzzle that we need to address: debt. Now, we all know what debt is, right? It's when you borrow money and have to pay it back later, usually with interest. But what you might not realize is just how much debt the world is swimming in right now. It's like we're all trapped in a giant spider web of IOUs. Governments are borrowing like never before, racking up trillions in debt to fund stimulus programs, social services, and all sorts of other expenses. And it's not just governments. Businesses and individuals are also taking on more and more debt, whether it's to buy a house, start a business, or simply make ends meet. This mountain of debt has created a tricky situation. Think about it this way. If you have a ton of debt, you can't really afford to stop growing. You need to keep spending and keep borrowing just to keep the plate spinning. It's like being on a financial treadmill that you cannot get off from. When a country is drowning in debt, it becomes really hard to let the economy go through a normal downturn. A recession could mean job losses, lower tax revenues, and potentially even a default on those massive debts. That's why governments and central banks are so quick to step in with stimulus every time there's a hint of trouble. They're trying to avoid a debt-fueled disaster. But here's the problem. All this stimulus, all this borrowing is not a sustainable solution. It's like putting a band-aid on a severed artery. It might make things feel better in the short term, but it doesn't fix the underlying problem. In fact, it might make things even worse in the long run. So we're caught in this debt trap. We're afraid to let the economy go through its natural cycles because we're worried about the consequences of all this debt. And the more we borrow, the deeper we dig ourselves into this hole. Okay, so we've seen how the old rules of economics might be getting a rewrite. Debt has become a major player, and the COVID experiment showed us that governments aren't afraid to destroy the value of your cash to keep the system afloat. But what does that all mean for us, for our investments, for how we think about money? Well, my friends, welcome to the new rules of the game. Rule number 1, cash is no longer king. Remember when we talked about how cash used to be a safe haven during economic downturns? Well, those days are over. With inflation and money printing eating away at its value, holding on to cash might actually be a losing strategy. It's like keeping your money under the mattress, except the mattress now is slowly catching fire. Rule number 2, bonds aren't the boring, reliable investment they used to be. Now they're simply boring. You can't rely on them anymore to protect you during downturns because their value will get eaten away by the money printer. So, what are we to do? That brings us to rule number 3. Real assets are the way to go. We're talking about things like stocks, real estate, gold, certain cryptocurrencies. These assets have the potential to hold their value or even appreciate when the governments and central banks are taking on more debt and printing more money. They're like the lifeboats in this crazy economic sea. This is why in my investing masterclass, in addition to different assets and styles of investing, I pay a lot of attention and go into great details of how money works, how it is created, and what it means for your savings. I have had great feedback exactly on this part of the class by my students who later joined the Dividend Method program, so I'm sure it will be useful to you as well. You can sign up for it in the link in the description. So, even though we as individual investors might learn how to play the game, it's not all sunshine and rainbows. This new game comes with its own set of risks. Asset bubbles can form, leading to sudden crashes and big losses. Inequality can widen as those who own assets get richer while those who don't get left behind. And who knows what will happen if the whole system finally collapses under the weight of all that debt and printed money. There are some serious risks and potential consequences to this new economic landscape that we need to talk about. First off, let's talk about bubbles. Remember when we said that real assets like stocks and real estate might be the way to go? Well, yes, but when everyone piles into the same types of investments, it can drive prices up to unsustainable levels. That's what we call a bubble. And bubbles, as history has shown us time and time again, eventually burst. When a bubble pops, it can cause a lot of pain. People lose money, confidence in the system erodes, and the whole economy can take a hit. Think about the dot-com bubble in the late 90s or the housing bubble that led to the 2008 financial crisis. Those were painful lessons, and there's no guarantee that we won't see similar bubbles forming in the future. However, as already pointed out, these crashes will be immediately covered by money printing, which makes the bubble even bigger. Another big concern is inequality. If the new rules of the game favor those who own assets, then the gap between the rich and the poor is likely to widen. Those who have the means to invest in stocks, real estate, and other assets will see their wealth grow, while those who don't will be left behind. This can lead to social unrest, political instability, and a whole host of other problems. It used to be the case that only rich people were allowed to play the game. However, because of technology, in my opinion, the divide right now, it's not so much about those with money or without, but it's about those who are educated and those who aren't. Even if you can only save $200 a month, you can still buy shares of stocks or reputable cryptocurrencies and protect yourself from the effect of money printing. You no longer need to store gold in a vault or buy a $200,000 house in order to not be left behind. And because of the power of the internet, you now have access to videos like this where you can get educated. Remember, the old playbook might not work anymore, but that doesn't mean we're doomed. It just means we need to be smarter, more creative, and more educated than ever before, which is, hopefully, what I'm trying to do with this channel. If you want to understand more about the topic of how you are no longer able to save money and how this mindset is ruining your financial future, then check this video that should have appeared on your screen. I will see you there.